All right, today we're going to take a look at a IUL policy, look at a statement from 2008. So we're now in 2025. Let's see what an IUL statement looks like on somebody that is now 80 years old. So again, a lot of people would say, oh, that policy is going to be way expensive. They're 80 years old. Let's take a look at it, see what the cost is, see how much insurance we're paying for, and look at the fees and look at it, what we call an in-force illustration. My name is Aaron Andrew. We're going to take a look now at this statement from 2008. Well, the policy started in 2008, and we're now in 2025 to see where we're at. All right, so let's take a look. I'm going to share my screen, and we're going to see, as you guys see these numbers here, this is a statement you can see. And one thing we're going to focus on, this is kind of a summary page. Now, it is, as of the time of this recording, it is the end of July of 2025 at the time of this recording. This statement, though, is from December of last year, and you'll kind of see that up here at the top, that this is December of 2024, this statement is. But let's just take a look at it and see what we're at. So this client is now 80 years old. Okay, she started this policy back in 2008. So back in 2008, right when the stock market was taking a huge dive and crash and everything, they were really excited to get into this and have, the money they had put in, at least into this policy, was protected and safe and so forth from market downturns. So to be able to show you that, let's just scroll down here and I will show you where it shows that right here. So the policy start date right there is September 17th, September 17th of 2008. So that's when the policy started. Now, first they started paying some money into the policy, and they paid up to $1.25 million, the guideline single premium. They paid that much into the policy over the first 6 years. They didn't pay right on time. That's what's kind of cool about indexed universal life, is you can be flexible with your payments. So they didn't pay right on time, but they got the money in there in 6 to 7 years. Then, after 11 years, you could actually pay more into the policy, which they did. So a few years ago, they paid some more money into the policy. So again, you got to realize that $1.4 million did not go into the policy all in the first year. It went in throughout, many years into the contract, that 1.4, and some of the, last couple $100,000 was, just a few years ago in the policy, just in the last few years. So they paid $1.25 million into the policy, all right? Their death benefit, if she were to pass away, their death benefit is, total insurance is $3.3 million is the total death benefit if she were to pass away. Now, one thing that's important in this contract is she could drop the death benefit and lower fees. They've opted not to because they don't need the money right now for tax-free income. So they're like, hey, if she passes away, the money in there will blossom to 3.3. So keep on track with me in this policy that they put in $1.4 million. Let's go back up now and look at the summary again. All right. They now have $2.7 million in the policy. So they have $2.7 million in the contract. Okay. This past quarter, well, from this statement about a year ago, they earned about $95,000 of interest, and they have money on different dates. So it's not all on one date, you guys. There's different dates they have money that they put in at different times through the year. So the money they had in the past during this quarter period, during, it says right here, September 2024 to December of 2024, that they earned about $95,000 of index interest, $400 of fixed interest. We had about $3,000 go out in fees. So right now, let's take a look at that. $3,200 is the fees right now. Now, again, that's for a quarter. So they're paying total of about $12,800 in charges annually for the policy. So she's now age 80. What is that giving us, okay? Well, to help you guys understand what that fee is paying for, what's the difference between $2.7 million and the $3.3 million death benefit? So if we do the math exactly, 3,320 minus 2,757, that's exactly $563,000. Why did I calculate that? Because in IUL, the $2.7 million is her own money. That's her cash value. If she passes away, you don't get both the death benefit and the cash value. And some critics will say, oh, they cheat you. They don't give you both numbers. They only give you your death benefit and keep your money. Okay, that's silly. That's silly the way that people word that, because we want it this way. We want the death benefit to be smaller, to have lower costs. We're going after cash value. So they're only charging her. They're not charging her for $3 million of insurance. They're charging her for $563,000 of insurance because that's the difference between the cash value and the death benefit. All right. So that 12 grand of fees, $3,200 a quarter at age 80 is paying for $563,000 of insurance if she were to pass away. Now, every year I meet with this client, we talk to him and I talk to him and say, do you want to drop the death benefit and lower the fees down a little bit? No, they say. They want to keep it up there because if they pass away, the 2.7 will blossom to 3.3. They could drop that death benefit, down to like, say 2.9 to 3 million, somewhere in there. They can't drop it all the way, but they can drop it down, or you could have lower insurance. So they're not paying for 500 grand of insurance. They'd be paying for less, and then their fees would be less. I'm kind of just teaching you guys how insurance works. Now, this policy, you can see, since inception, this policy has averaged just under 7% return. Pretty awesome from 2008 till now that we've averaged 7. Now, could we have averaged higher? Yes. Could we have done lower? Yeah. It depends on which index accounts the company has and what accounts we're in. You can see that through the years, they have some money in the fixed account, just a little bit. They have most of their money now, 90% of their money in the 1-year S&P account, and that is averaged 6.5% through the years. So that's average 6.5. They had for a few years some money in the international, only 4% because we were only in that for a year or two. The 2-year account, they still have some money in the 2-year S&P, and that one is averaged 7.65 annually. The annualized rate of return is 7.65 in that. They got out of the 5-year. I wish they would still be in the 5-year because they haven't used this money. But as they got older, they got more conservative. They wanted to go shorter term on a 1-year. The 5-year S&P account is wild. It's really cool, but you have to wait 5 years to get a return. And it had no cap on it, no cap on the S&P, 105, 110% participation rate. It was amazing. So you can see when they were in that one back in the day, they don't have any money in there now, but they earned an average of 12.78% in that account. So if they had stayed in that account, yeah, they'd be around 10, 11, 12, 13% average return probably, because that's what it's been doing since 2009. That 5-year account through the years with all those years is about that kind of return. And it's done very, very well. And I have some clients that are doing that. But this client slowly moved money out of the 5-year account back into the 1-year to be more conservative and to see returns annually instead of every 5 years on their index accounts. So a little bit of detail there, but that's kind of just giving you an idea of where they're at, and it shows kind of the pie chart of where their money's, mixed up. So basically, as this account's been growing, they have $2.7 million in there. They have not taken out any loans because they haven't needed to, but they can take out loans. So this policy, again, has been around since 2008. So we're talking like 17 years? This policy's been around, and this policy is doing very well. They're age 80 now. The cost is very low. They're earning good returns. And now let's look at what we call an in-force illustration. So if we look at what we call an in-force illustration, you can see, yep, we're 17 years in, age 80. You can see in this illustration that we've got, 2.8 million in there now in this projection, 3.3. If we drop the death benefit, we can only drop it a little bit, but you can see, I'll show you the fees in a second. But if this client decides not to take out money like they're doing right now, they don't take out money, look what happens. If it just keeps growing at a very conservative, 5%, that's what we can run by law. I've been earning higher than that, of course, as you guys know. You just saw, but you can see this account grows and the death benefit pushes up, okay? So in this example, if we get to like age 100, we'll have about $7 million in there, 7.2 if we pass away. Up here, age 93, 5 million, 5.2 if we pass away. So this just gives you a projection of conservative example showing lower than what we've been earning on average, what it would look like going forward. Let's look at the fees too, because a lot of times critics will talk about the fees and expenses. So if we scroll down here and look at this next page, this shows the fees. So right here, if we drop the insurance, like I said, the fees are about $9,000, but they can drop down to $3,000. They go up again as you get older a little bit. But this shows all the fees and expenses. So again, the client's not paying any money into the policy. Again, see they're 17 years in, age 80. You go to the next years, these years are supposed to be so expensive, people say. All right, yeah, there's some expenses, but you can see as we scroll over here and look at the different values here, you can see that those charges, the total charges here, because all we have is our $90 admin fee, administrative charge, and then the cost of insurance. But you can see how cheap the policy is. Even at age 87, the fees are $7,000. but we earn $168,000 of interest if we earn just a conservative 5% in this example, and we got $3.8 million in there. 3.7, the year before, 4 million, 4.2. This is very, very realistic because we've been earning on average almost 7%. This is projecting it at 5 and showing the fees going forward. You guys, IUL works. Take a look at this. I mean, it's all right here. It's all laid out, what our interest projections are, what our fees are, and this is going forward. Let's take a look at loans though. If the client wants to take out max loans, if they said, hey, what if we only earn this conservative 5% and we want to take out max loans, let's take a look at this and see what the policy looks like. So same example, but now we take loans. So this client, we show an example of taking out what we call withdrawals to basis. So just a little side note, you don't want to take out a withdrawal in the first 15 years. So in an IUL or in a policy, you want to take out loans usually, but after 15 years, you can take out withdrawals if you want. So this client, we're taking out our basis. What did we put in? Remember, we put in 1.4 million. So we can take out our basis tax-free. Then we switch over to loans at that point, because if you continue to call it a withdrawal, you guys, that would be what we call the dumb way. That would be taxable. You switch to a loan, it's tax-free. And in this example, what we're doing is we're borrowing at 2.25%. So we borrow at 2.25 is what we're borrowing at. And then the cash value, the collateral for the loan, the money that's in the policy that you're borrowing against, because you did not withdraw, you borrowed against it. So the collateral is earning 2.25. So the money's not earning those the 6.5% or 9% or the 7% almost we're earning. It's not earning those returns. The collateral is gonna earn 2.25. The loan is charged 2.25. The money that's not collateral for the loan continues to earn the index returns though. Continues to earn the great returns that we've been earning in the policy. But you use this conservative zero wash loan and we borrow at 2.25. The money earns 2.25. It's called a wash. So you're taking out $227 a year tax-free. And if she passed away at let's say 95, leave behind $840,000 to the family. Down here at age 99, we depleted it down to $14,000. So we could take out a total of, this is actually the net outlay. So over and above what they put in, they took out $4 million, $4.3 million out of the policy, all tax-free, all those years. 4.3 million tax-free. Anytime we pass away, we leave behind the death benefit tax-free. So pretty cool. When you kind of look at the numbers and look at an in-force illustration of taking out loans. But right now, today, the policy, we've got about, what did we say, about 2.7 million in there. If we earn our average still of about 6.87, I think it was, we're going to earn about $185,000 of interest. And the fees could be $3,000. We're opting for around $12,000 in fees to have the higher death benefit still. And you can kind of see there's different ways to kind of, run these policies as you get a few years into them. But it looks great. Let's look at the fees in this example. So here we go, scroll down and look at the fees and expenses. So here's all the money coming out. Loan interest that you're not paying, it just adds onto the loan balance. But the fees are right here. There's your total charges. So the fees are very, very low into our 80s and into our 90s. They're very, very cheap when you've got, 2, 3, up to $1 million in there at age 93. And we're taking out $227,000 a year tax-free. So does IUL work? Yes. Okay, you can see in these examples, looking at an in-force illustration, what the contract's gonna look like going forward and where we've been. Again, we put in 1.4 million, we got 2.7 in there. We've been in it since 2008 till now, put in money throughout the years. Policy looks awesome, doing great. And this is how an illustration or a policy looks after 17 years now. We're 17 years into the contract in this policy now. A good size, and you don't have to put this much money in. This is a larger one, so I like to show this one because it has a larger amount in it, but you can put in smaller amounts, of course. So everyone's in a different situation of how much they would put in. So if you want more information, make sure you go to laserfund.com, order a copy of our book, the one that my dad, my brother, and I wrote together, and take a look at chapters 6 through 10. Read those chapters, give us a call, and we can design a policy like this for you. And a lot of the contracts even now have even more bells and whistles and features than these older ones, even though this policy has lots of good features in it. There's so many cool new features we have in these contracts now with different loan options, different index accounts, and so forth. But yeah, take care. Go to laserfund.com, and we will see you guys in the next Does IUL Work video.